Hi everyone, my name is Adam Harris, and first of all to Lisa Campbell and the organizers, thank you very much for inviting me to join you today at this event. It's my first time speaking at Sustain.Social, and I'm very happy to be here. So the topic that I've decided I want to talk about here is the building a more forward-looking investment portfolio. Again, my name is Adam Harris, and what I'm going to do here is I will kind of walk you through the thinking here. Okay, so first of all, obviously, as we understand it, the definition of sustainable investing or socially responsible investing is the process of incorporating environmental, social, and governance factors into investment decisions. Okay, so it's not just us, where we choose to put our money, but we would hope that it's also going to be the leaders in our society who are going to obviously take into account that there are consequences to their actions, which is why I've kind of listed here and said that the criteria is obviously it has to be ethical. Some of these should be obvious, but kind of looking at leadership behavior over the last few years, I sort of feel that they tend to operate in a consequence-free environment, and we just, the world today has become almost one world, and I think that the consequences and repercussions of our actions, even on a smaller scale, have more impact than they might have had, several hundred years ago, or even just, 80 years ago. So we want our decisions to be consequence conscious. I want to be looking for leaders who are actively looking for alternative solutions to, sourcing energy, for example. And there are some costs, there is a cost-benefit ratio. We also have to think long-term. We're going to have to be thinking 50 years into the future, but we also have to be thinking, because I think that there's a lot of pressure right now, we have to be thinking 5 years, 2, 3, 4, 5 years in the future. It should be cost-effective. So now, initially, unfortunately, it had to be, there might be an upfront cost, but we have to look at the total cost. One of the things that I think is amazing right now is, for example, is a lot of the stimulus cash or infrastructure spending that the US is attempting to put in now, which will pay off over the next 10 to 50 years. It should be sensible. It's got to be something we need. It's not just something we want. I think we've forgotten, because we live in a world, and I'm generalizing here, but most of us are not necessarily living hand to mouth. We forget about what needs are as opposed to what wants are. It should benefit others. So this is our philosophy should be that we are thinking for the community, and of course it should make sense. I've said that before, sensible, so I think that's fair. I can reiterate that. And of course, I think here, in terms of from an investment perspective, this is not new, and a year goes by like this. I think most of you would agree with me. Quarantine has been around for a while. Speaking of which, just as well, I'm in a really small box because I've become obviously quite fat thanks to quarantine. So, I think most people, again, can relate to that. So I think it's acceptable that there should be an established history, a track record of 3 to 5 years in terms of performance. So let me kind of proceed and take us through this. So there's a few people, and in fact, I can own up that I might not even necessarily know of all the people that are doing this, but certainly Kathy Wood, who runs ARK Investments, I very much admire her. I think the pro is I think she's very sensible. I think she's forward-looking. She's looking at all kinds of things that humanity needs as well as the planet. And I'll talk about a couple of those things in a moment. But at the same time, there is a real danger of us being able to rationally justify a lot of decisions that we make. And it's a concern of mine that Kathy is capable, she's clever, she's smart, she's educated, that she might on occasion be justifying why her ideas should work and not necessarily why they're not working. So that's just something that I think about a lot. Warren Buffett and Charlie Munger, you might not be familiar with Charlie Munger, he's Warren Buffett's right-hand man. Now, Warren Buffett is always betting on, to use an expression, he's always betting on American industrialism, meaning the workforce. That's where he feels, things are going to work. But I think at the same time, he is conscious that the world isn't necessarily sustainable the way it goes. And so I'm always watching him and observing where he's looking to make changes or add additional stuff to his portfolio, him and Charlie as well. Charlie they're both conservative, very old-fashioned, but at the same time, I think also very much open to what's important, and that's really why I quite like them. Now, Elon, I'm not sure that I want to take credit for the fact that he's South African and I'm South African. I'm not sure that might not necessarily be a good thing. I respect him because I think that he was the guy when no one really was going to commit to doing electric cars, he did. And for that, he deserves all the credit. He has he is just going, look, I'm going to do it, and everybody else is now following suit. And in fact, so he has almost single-handedly globally had that kind of, I'm okay with an electric car, switch to it, and has changed the tide on that. And it couldn't have come soon enough, where I would have preferred it to happen sooner. However, at the same time, I do think that at some point his success might get him to a place where he's drinking his own Kool-Aid, and everything, he'll believe that everything he says is absolutely accurate and true, and there's always a bit of a danger to that. But with regards to the concept of us switching through to electric cars, and the other thing, that there was a feature in one of the electric cars where there was this amazing filter, and it's used in terms of filtering out chemical attacks, and he had built this into one of the cars, and it was eventually like a package option, and I love that idea. It is actually feasible that it's possible we could put into cars a filter that would actually filter the air, and so the more electric cars down the road, the cleaner the atmosphere could actually be. And I think that's a phenomenal idea, and I think that should become a policy, but it's not a policy yet, but it's possible. That could be something that happens. Right. So let's start talking about actual kind of ideas here. So I brought up cannabis. It's a subject that I think is worth looking into. I'm not a smoker. I don't have any judgment on this. I don't really, from the outside, have not had any bad experiences with anyone who uses this. So I don't really have any negative connotations. I do know that there's a wide variety of applications for this. And actually, if we just, there are so many in terms of pain treatment, materials that can be used. It's highly renewable. There's very few, if any, downsides to this. Especially cancer treatment. So having lost 3 in my family, both parents and a sister, to cancer, I'm aware of pain. My sister, who passed away in July this year, it's just life, I guess. It's just how it happened. She was much older than I was. 14 years older than I am. And pain was a big part of it. So she was in pain for 2 years because she just was, and so I would, for me, I think there's some value there. It's socially awkward because it's a topic most people aren't even sure if we can really talk about it, but all it really is a plant, and we can take the good with the bad, and there's actually very little bad to it. I think the total number of deaths attributed to cannabis historically worldwide is like 0. So it's not, it's not a problem compared to, say, cigarettes. But that's a separate discussion. It has good potential. But it's not there yet. So the chart that I'm showing on the right-hand side is a weekly chart, and actually it goes all the way back. It goes back quite a bit over most of the history of it, and this is the performance of most companies that are within a basket, and this is their performance over that period. And so although there has been a bit of a spike in it, what it's not really showing us is conceptually it's going, okay, it's a great idea, but obviously the underlying constituents are not generating revenue or return at this time. So very importantly, what I want to highlight here is that you can see, especially if you go back sort of February 2021, you can just see that there is a continued decline in its performance all the way down to the lows. And so collectively, this industry, although I believe that there is a future for it, is not really showing any particular areas where there's growth. And what we need is, it's not just that we must have an initial response, we need a continued growth in order to consider investing in something from that perspective. But in terms of what its potential is, or its service to humanity, it's already there. Okay. It's kind of like saying, well, obviously we need air to survive, but if there was a company dealing in oxygen for the last 20 years, would they have made a profit? Probably not. So there isn't really a market there. So the next one is genomics. Now, this is a really important topic or concept or investment idea, is the editing of our genomes. If you look at something such as CRISPR, which is definitely something you want to have a look at. There's a documentary online, I think it's also on Netflix, to do with CRISPR, but gene editing is, let me put it this way, probably the most important area where this would be is ultimately a cure for cancer, on the saving humanity perspective. It would have a range of solutions with regards to fixing diseases, MS, so multiple sclerosis, all these things, even perhaps dementia, all kinds of things where we would have that ability. If it's a inheritable characteristic, we would likely be able to fix it. So the potential for this, for humanity as well as animals on the planet, survival of them, is huge. and I believe in that. But similar to cannabis, it's not really going anywhere. And you can see the performance over the last 12 months, just not really going anywhere. But I wanted you to be aware of it. So if you have never thought of it, this is an area you want to be keeping an eye on. And one of the ones you could monitor would be ARC, which is Kathy Wood's company. It's one of her ETFs, and it's Genomic Revolution, would be to monitor the performance on that. And I would say that once we start to break above these highs here, above 80,000, starting to break a little bit higher here, then I would say it is becoming, then there is some potential future to it. So, and I think there's absolutely some, so I've regarded both this and cannabis, I put them down as a fail. And that's not because inherently they won't benefit us, but because they're not showing a return. And until they show a return, from our perspective, it's not really worthwhile. Okay, next up, so lithium and battery technology. This one I really like. So this is a longer term kind of chart. We can see it's actually grown. It's grown quite well this year. It's going through a little bit of a correction at the moment, but it has broken past historic highs. So what does that mean? It means that the trend for this, and generally if you look both down at the indicators, they're both trending higher as well. It's bullish. So it's a growing market, it's going the right way, and certainly for me, when I look at this, especially now as we're approaching these old highs, we're coming back into the moving averages, this is usually an entry point for me. So from, when I'm a technical trader, but usually I'm a huge fan of value investing from, I've been influenced by Warren Buffett, Charlie Munger, but for me, this area represents for me an entry opportunity, a buying opportunity to get into that. So it's not socially awkward. I need to edit that. It's not socially awkward at all. But Amplify ETF is the ETF where this is taken from, and I think it's performing particularly well. I quite like that. So Amplify ETF looking pretty good there. Apologies for the socially awkward. Next, so this is also a good idea, but also really good performance. It's renewables. Okay, so we all know in principle we've got to recycle renewables as well. It's a great idea. It's established. It's got the track record. It does actually make sense. It does meet a need. And one in particular, interestingly enough, is a Chinese company, China Daitang Corporation, Renewables, and the performance is very, very good here. So this is particularly powerful. We can see it's got a nice upward trend. Again, it's back into this area here, which for me, generally speaking, represents a bit of a buying opportunity. There's a bit of a struggle up here. So here it's entering kind of a bit of a high-priced area around here. But if I'm thinking of being in a position or adding this to my portfolio for a period of, let's say, 6 months to 2 years, which we'll talk about in a moment, that is really where I want to be. Next one. Again, good idea. Actually, a great idea, great performance. So this one is waste management. As long as we continue to have this really growing population, to give you a frame of, to give you sort of some perspective, the population can only really cope with about 4.5 billion people, which is roughly what we had when I was born, which is in the 1970s. And we've almost doubled since then. So that was really where we had about the right amount of people, and so we're really straining our existing resources. So waste management is in use right now. It's been in use for several years. You can see it's really growing. Again, these are weekly charts. So this is showing a couple of years with performance, and generally speaking, the trend is up. And it's also, again, coming back into these areas where it's likely to then continue from that point onwards. So I quite like this. Overall, the trend is nice and bullish. And therefore, for me, this is where I'm expecting to see a return on my portfolio within 6 months, at least. This is where I'm expecting to actually go up in value. I say it's recession proof because actually this is happening whether people are employed or not. We're still consuming food on a daily basis, consuming goods. Might consume less, but we're not necessarily going to eat less. And so we're still outputting that amount of waste, and therefore the waste needs to be managed. And so it's recession proof from that perspective. And so it has good potential. And this one is actually derived, this particular chart is derived from Clean Away Waste Management. Clean Away Waste Management, very, very nice. And then we get on to this one as well, which is fantastic. This is now, again, back to lithium and battery technologies. So there are some concerns about the production processes and the side effects and the waste around battery technology. However, obviously, now that we're switching over to a lot more electrical goods and we're looking at solar power and various other solutions, we're obviously going to continue to look at different battery solutions as well. And so actually saying that this isn't really an option because the waste of it is worse than other stuff, a lot of that is really misinformation and disinformation. This really is one of the best opportunities we have for survival, doing the least amount of damage to our planet at this point in time, at least if for no other reason as a stepping stone. So obviously in terms of technology now, what we want to do, I think, is get into the headspace of, you know what, it's worth our while investing in these, even if we don't see the value immediately. We need to start thinking 5-10 years in advance. I was just going to add something really interesting to that. Most people don't know this, but it's worth looking into researching independently, but many people don't know this. But the very first cars that were available to the public historically were electric cars. So they weren't actually petroleum-based vehicles, they were electric cars. Most people don't know this. So the first cars that we ever came into existence were electric. And I always think that's really interesting. But again, similar to VHS versus Betamax, the petroleum-fueled ones won out. So again here, Global X Lithium and Battery Tech, it's an ETF as well, which is an exchange-traded fund. These are great because it's a basket of goods for the most part, and generally speaking, it's lower risk and the cost can be quite good as well in terms of getting involved in that. I really like this. The performance on this is absolutely outstanding compared to some of the others. So then risk management approaches, and I'm just keeping an eye on the time here. We've got about 4.5 minutes. Risk management approaches towards this. I'm very much influenced by Ray Dalio. Okay, so if you're not familiar with Ray Dalio, he's really worth your while following on LinkedIn and YouTube. Written a series of books. He's a very successful investor, and he spends a lot of time trying to philosophically become a very balanced individual and pass as much wisdom as possible, and he's got quite a bit to do that. So he's got this thing called a holy grail, which is really, his idea is that the more you diversify, the more you reduce your risk. But now Warren Buffett would counter that by saying, if you know what you are doing, then diversification is a waste of time, because everything you add should in itself have a high, success, a high rate of success or high chance of success. But even Buffett has had failures. So I lean more towards this kind of approach here, where the whole idea here is you don't have to be crazy, but you do want to diversify with a few different options here. And that, for example, that would be, say, 3 to 10 constituents, meaning 3 to 10 different ETFs or a number of different stocks, equities that I might have, looking at maybe a few ETFs as well. Minimal overlap, meaning if I have money in the NASDAQ, if I'm holding NASDAQ stock or the index, if I'm in the index, and I also own Apple and Facebook, then there's duplication because Apple and Facebook are obviously listed they're one of the constituents of the NASDAQ 100. So I want to be aware of it. You don't have to avoid it, but you need to know what is your exposure in terms of that. And 2 to 5% drawdown cutoff point. So this is really where there's been some amazing success from traders / investors historically, where they look for a nice little consolidation in a chart and then look for an entry after a breakout of that consolidation, and usually have an exit point below that. And this is where they get astronomical returns on their investments. And so the 2 to 5% drawdown really means that if I have a certain amount of capital, I could potentially, have a cutoff point below that where I go, look, this upward trend should continue upwards. I'm going to put my exit point below one of the nice little swing lows, and should the market not continue up, but something happens, for example, and then it ends up dropping, I'm out. And that maximum cutoff, the amount of capital that I've lost would be 2 to 5% of my initial investment. But that would then also cap, to a degree, how many constituents I can get involved in. But it's an approach. It's a starting point for people who've never really considered it. You do want to keep your costs low. So if you're holding a position for 6 months or 2 years, you really don't want to be paying fees, because you've got inflation to deal with. You've got the risk of, will this actually work or not? And you really don't want to be paying too much on it. So you want to keep your costs low as possible, and actually just paying management fees. So here's the problem. Getting in and out of the market on a frequent basis just adds up to costs. It doesn't necessarily guarantee more profits, but it certainly guarantees more costs. And so really, positions ideally should be 6 months to 2 years. Holding periods, as I said, would be roughly that. And then I would judge the performance on a quarterly basis, meaning the market is going up and down and up and down and up and down as it breathes. That's normal. So I really don't want to be judging it on a daily basis, because you're just going to go mad doing that. But you could look at it on a weekly, quarterly, 6 month basis. It should generally be going up. And diversity, as I said, that is the idea, that it should reduce it. In summary, I was going to say, don't fear the future. This is something I've actually picked up from my brother. I know the pace at which the world is changing is frightening, but actually we are much better off if we engage and guide us. We engage in what's happening, and we're also in a position to guide it, to go, look, we don't really want to, I don't want to be seeing my money go there, I want to see it going here. Energy consumption is absolutely going to increase when you think about the fact that cigarettes are electric, books are electric, lighters are electric. We've got so many things that are now going that way so that they can be recharged. But the consumers need to be saying, listen, this is where I want, this is what I want. And so it will be demand driven, but on a local level, we absolutely have to pressure politicians, for example, to deliver on that, because a lot of them are absolutely still paid and effectively funded by the wrong industries. And we need to be putting pressure on those on an individual basis. It's not enough to expect our local politicians to make those changes. It has to come from us. It has to be expressed online, individually. It has to be done in that sense. And ETFs, what I like about them is that they can focus in these areas. There's a variety of ETFs. We can look at those. We can see what the constituents are. There's usually a guide as to what this ETF is meant to achieve. And so we can pick them in that perspective, from that perspective, not just the performance that we see, but what is their purpose, what's their goal. Okay, so thank you very much. I hope that you enjoyed this. I was going to say, if you do want to find out a little bit more, or you want to engage with me a little bit more, of course, I'm happy to get both, I guess, constructive feedback, positive or negative. But you can find me on YouTube as London City Trader, or you can find me on LinkedIn. I've just provided you with photographs so that you can recognize me if you do find me there. And that is it from me. So I hope that you found this instructive and useful. I've tried to keep it brief. I am optimistic. I do think there's a lot of opportunities out there. And it's just a question of staying away from the ones that just aren't ready yet, and maybe perhaps engaging in the ones that are already established and delivering. All right, thank you.